Good afternoon. Thanks for tuning in. You're watching Countdown on BloombergQuint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking at this hour. Markets begin to gain momentum in today's session. Banking and pharma stocks are outperforming in trade. Financial stocks rally led by state-run banks after the Supreme Court upholds the Committee of Creditors' right to decide on the rights of distribution of claims, says the principle of equality of creditors is flawed. Bharti Airtel and Vodafone Idea both are trading with gains despite posting a combined loss of 74,000 crore in the second quarter. Bharti Airtel is the top Nifty gainer. And Glenmark Pharma has gained the most in 4 years. This after the company reported strong results for the second quarter with growth seen across geographies. Good afternoon, Neeraj. We're at the day's high and it's all about the banks today.
Yeah, it is all about the banks today, and naturally so, Navneet. The judgment that has come in certainly puts some power in the hands of the creditors of this case and probably some other case, and as a result of which the Bank Nifty has done very well. It's still trading about 1% higher. You can argue that it's off the peak, but hey, it's trading in that range wherein it's about 1%, and which is actually very good news. And a lot of public sector banks, a lot of creditors are doing well. We'll of course speak to one of them, which is Edelweiss ARC, not a bank but a financial institution which has exposure, also doing well. But bring up the heat map and show you what's moving on the Nifty 50, and then I'll highlight what's happening at the broader end of the spectrum as well. Firstly, the Nifty 50 gainers should come up on your screen. Let's get the heat map up and show you what's moving and what's not. So Bharti Airtel, a mammoth 8% along with Bharti Infra, which shows you that the markets have actually taken this the statements that the companies have given and the amounts that they have put out on the balance sheet, saying that this is it and this is what we can do, as probably positively hope for some action or otherwise, because it's a big move that has come into both of these names. And by the way, Vodafone Idea too is in the green. Keep that at the back of your mind. State Bank of India, the big lender, up about 5%. Not that the others have followed suit. ICICI Bank is still up only about 1%, so nothing dramatic there. But for SBI, it's a big move and the stock is doing well. There is Grasim, Cipla, Tata Steel amongst others which are doing well too. What's not doing well is the U-turn that IOC has taken after yesterday's uptick, down about 3%, and UPL down about 2.5%. If you can also pull up what's happening at the mid-cap and the small-cap end of the market, the MRR function would be helpful out here, and we can just get the mid-cap and the small-cap indices and just show you which are the stocks that are moving around. So if you look at what the gainers list, Glenmark Pharma, result reaction. Balkrishna Industries, again, result reaction, not quite the reaction of what the statement was about the growth numbers. And then a clutch of banks, again, lenders, BOI, IDBI, Canara Bank, Oriental Bank of Commerce. The entire pocket has done well. JSPL continues to gain favor, so good going there. What's not doing well? Graphite India down about 1.5%. HEG numbers, very poor, and that stock is down about 3%, as also Future Retail down about 4%. And the small cap end of the market as well, you'll probably have stocks which are moving around. Credit Access Grameen up about 4%. Again, lenders out here. Syndicate Bank up about 4% in trade, so good going. ITI has some gains to itself. PSU name up in trade, as is Rail Vikas Nigam. What is not doing well? Divan Housing Finance, MOIL, and to an extent Hindustan Copper down about 3% in it. Some PSUs taking a bit of a backseat. But the important thing is also the first day of the new weekly series of sorts starting off, and banks doing so well. It'll be interesting to figure out from Navneet what's happening at the futures and options end of the market. Navneet.
Thanks for that, Neeraj. Well, clear signs of long positions being created, at least for Bank Nifty futures, as the open interest has gone up by about 13%. And as we speak, Nifty, by the way, is up about 70 points in trade. Remember, for the week we were trading in that range of 11,800 to 11,950. So remains to be seen if we can close at these higher levels. And from here on, I think on the top upside, traders will be watching out for the recent high last week that we'd seen on Nifty of about 12,023 thereabouts. But good news is also that the VIX continues to cool off. While it was down 5% yesterday, it's down another 4.5%. In fact, it is right now below the mark, tad below the mark of 15. Very quickly then, how are the option positions looking like? Maximum open interest for next Thursday's expiry on the call side 12,000. Put is now at 11,900. So once again, we're staring at a very narrow range, and in today's session both these two strikes have been quite active on both 11,900 put and 12,000 call respectively. Between 12 to 13 lakh shares have been traded. So we're staring at a narrow range. Again, we have to break away from first last week's high and then of course all-time all-time high on Nifty, which is at 12,103. On the stock futures front, Bharti Airtel, your top Nifty gainer. Of course, the numbers operationally looked better, but there are a lot of long positions today on the futures side. Open interest has gone up, but also look at the options data. The next level that the traders are watching out is the 400 strike, because that 400 call has seen maximum open interest addition, and it has also got the maximum concentration right now, while put writing has been seen at 370, 380 levels, and of course the stocks approaching that mark of 400 right now. SBI has also seen fresh long build-up. I was just looking at the activity. 27% of the quantity traded so far has been marked for delivery, giving you a sense there is cash-based buying also seen besides long build-up on futures. And interestingly, Cholamandalam investment, the counter has risen about 8% in the last 2 days. 57% of the quantity traded has been marked for delivery. So this particular stock has been witnessing both cash-based buying as well as long positions on the future side. So good going for this one, up 4.5% today, open interest higher by about 30%.
Okay, let's get into market wire. Shibani Sarkar Kurian of Kotak Mahindra AMC joins us right now on the show to talk about her thoughts. Shibani, so good having you. Thanks for joining in and taking the time out. I wonder, Shibani, if you are as enthused about the verdict today as some of the banking stocks are, because it's not just a verdict on a particular case, but in all likelihood a verdict around this whole IBC process, and would augur well for some of the other resolutions that are being hoped for as well. I'm not painting the sky blue or green, because there would be some chinks in the armor, but net, is it a big positive?
Hi, good afternoon, and thank you so much for having me on the show as well. Yes, I think that on the IBC side, IBC by itself has been a significant step and a progress towards resolution of these cases. Clearly, the progress has been delayed because of litigation. Today's judgment at least helps in expediting some of this, brings clarity in terms of the waterfall between financial creditors and operational creditors, and therefore would set a precedent for some of the other cases where the same issue could come up, and also clearly states that the resolution process as defined under IBC, where the committee of creditors takes the final decision, that holds, and therefore that paves way for possibly faster resolution in some of the other cases. So I think that is extremely important. This particular case was pending for a long period of time, and therefore brings relief. A lot of the banks that you're talking about, specifically the corporate lenders which have exposures to some of these accounts which have gone into NCLT, remember that the provisioning in a number of these cases have already been done, and therefore the resolution process and the speed of resolution becomes important, because as soon as the resolution happens, these banks are able to write back some of these provisions, and that aids profitability and also gives them additional capital which is required to grow. So I think that if this particular verdict helps in speed up the process of resolution, brings clarity in terms of how to approach the entire case in terms of the waterfall, all of that is a positive. So our view is that if you look at some of these large stressed accounts, most of the recognition and provisioning for these accounts have been done, and therefore faster the resolution, the better it is from a profitability perspective, because then incrementally credit cost starts to come off, because then you are able to write back. So I think yes, it's clearly a step in the right direction. We'll have to see how this works out and whether that helps in expediting some of the other cases which are pending. But yes, this is clearly a welcome step.
Shibani, would you, as somebody who's heading the research desk and investing for client money, would you bake in faster resolutions as a more probable outcome for the creditors in the Indian system for the other few cases as well? And therefore, would the outlook for some of these lenders which have large exposure to these stressed accounts improve materially for the next 4 quarters?
So, if you look at some of these corporate lenders, and if you look at our view on corporate lenders has been, specifically the private corporate lenders, has been that yes, there has been a delay in the resolution process. However, since the large part of the recognition has been done, also a large part of the credit costs or the provisioning has also been done. As and when the resolution happens, it's a positive. Now, whether the resolution happens by the end of this fiscal year or maybe spills over into next fiscal year, if you take a 2-year period, clearly there is very high probability, or let me say fairly moderate to high probability, that this resolution would happen at least over the next fiscal year as well. So if you take these 2 years in combination, it is possible that once this resolution starts to materialize, the credit cost trajectory clearly will be on its way down, whether it be in terms of incremental slippages because of large stressed accounts, or be it in account of amounts being recovered and therefore you have lower net credit costs. All of this means that the return on equity trajectory for the corporate banks, specifically so for the private corporate banks and a few select PSU banks, is likely to improve. Also, it means that as profitability improves, you get higher capital requirement, and therefore the ability to grow also is better. And finally, specifically for some of the private corporate lenders, what we've also seen is that one side is the lower credit cost aspect, which is driving the ROE or return on equity expansion. But on the other side, they've also done very well in terms of overall granularization of the loan book as well as on the deposit book, which is leading to market share gains both in loans and deposits, and therefore better operating profitability as well. So it's not just the provisioning line item where you are seeing improvement over the next 2 years, you are seeing improvement in terms of operating profits as well. So all of that means that if you take a 2-year horizon, there is a definite trajectory of ROE and ROA improvement where some of these corporate lenders are concerned.
Okay. Good going for the banks on back of that verdict which came today, and we have seen most of the PSU banks going up. The Nifty PSU banking index today has been the top sectoral gainer. Shabani, hi, good afternoon. Away from this verdict, a word on the Q2 earnings, which we've wrapped now mostly. So far, it's been slightly at least above what the street was expecting. Now, do you believe the second half could be better than what we've seen in the first half?
Yeah, so that's the hope and the belief that yes, going into the next half of the year, you will start seeing some improvement coming through. If you look at the Q2 results, pretty much results have been more or less in line with expectations. Of course, a few misses here and there. I think we have to look a little ahead. A couple of things that are clearly working in our favor. Of course, we have to contend with the slowdown in terms of growth, and I'll come to that in a bit. But if you look at from a positive perspective, as you enter into second half, one is that the corporate tax cuts have already happened, which means that there is a floor in terms of earnings downgrades, and therefore visibility that you will possibly end the year close to double-digit earnings growth. Therefore, after a long period of time, you are going to see earnings growth from a Nifty perspective. So that's number one. The second is that from the government perspective, you also started seeing steps as well as flow of money into the system, and therefore some pickup in terms of government spending, which bodes well in terms of flow of money. Thirdly, hopefully because of the monsoons, and while there's a lot of debate in terms of the impact on the Rabi sowing season, hopefully the Rabi sowing season goes as per expectation, and therefore you will also see over a period of time some improvement in terms of rural cash flows. Commentary from management has been fairly circumspect. So nobody is really calling out a significant V-shaped recovery, and it's unlikely to be a V-shaped recovery. It's going to be a slow and gradual movement in terms of recovery process. Of course, the macro data that is coming through is fairly muted, and similarly so with the GDP numbers, etc. So it's at this point in time almost like, you know, a tale of two cities, where you have the best of times and you have the worst of times, and somewhere the market is trying to, you know, muddle through that. What we are also seeing is that while you are talking about growth slowdown, you have the headline Nifty possibly having done really well over the last year and a half, and therefore the divergence between the Nifty and the broader market has significantly widened. While valuations may look stretched at the Nifty level, from a valuation perspective at the broader market or the mid-cap level, there is significant amount of comfort, and therefore if trends start to improve and things start to improve on the ground over the second half of the year, there could be some amount of catch up which the mid-cap companies do vis-a-vis the headline Nifty numbers. Also from a company perspective, and this was a trend that was visible in the second quarter, and of course it's stock specific in nature. While the growth outlook has been muted, a lot of focus has gone from companies in terms of improving their balance sheet as well as cash flows, with focus on improvement in terms of operating cash. And that is something that is going to bode well for some of these companies as growth returns. And therefore, from a broader market perspective, we are trying to look at these sort of companies where you have a strong balance sheet, low leverage, improving operating cash, and therefore possibility that as growth returns, you will start seeing the valuation catch up take place as well.
Shivani, then in your assessment post the numbers, do you foresee any sort of sector rotation then?
So if you look at the kind of sectors where we are positive on, we are more positive on the domestic companies vis-a-vis the export oriented sectors. Therefore, we are cautious on IT as a pact. We are also fairly stock specific on the pharma space, but from the sector perspective where we are positive, we have been positive on the private sector banks, specifically so the corporate private banks. We've also been positive on insurance as a sector. Apart from that, we do believe that over the next 12 to 18 month period, there would be some improvement in terms of investment led activity in the country. From that perspective, some of the sectors that we are positive on include cement, industrials, capital goods, where we are expecting that over the next 12-18 month period, you see some pickup in activity led of course by public sector capex, not immediately by private capex revival, but as public capex spend starts to pick up over a period of time, these sectors also benefit. Apart from that, oil and gas is also a space where we have been positive, with specifically on the gas utility side, where we do believe that both trends in terms of volume growth as well as the overall thesis that these companies benefit. So that's another space where we have been positive on.
All right, Shivani, thanks very much for joining us. Really appreciate you taking out the time this afternoon and being with us. Moving on then to one of the most important hearings this morning, the Supreme Court has ruled in favor of the Committee of Creditors in the Essar Steel insolvency case. Setting aside the NCLAT order, the court said that the distribution of claims in the matter will take place according to ArcelorMittal's resolution plan, while banks are cheering the move in today's trade. How are ARCs or asset restructuring companies like Edelweiss likely to be impacted from this move? Let's ask Mr. R.K. Bansal. He is the Managing Director of Edelweiss ARC. Mr. Bansal, thanks very much for taking out the time. Definitely a big move by the Supreme Court, and it goes in favor of asset reconstruction companies like yourself as well. A big positive for you.
Yeah, that's correct. Basically, this sets the distribution part very clear for the lender's perspective. So it's not only for ARC, it's basically good for all the lenders. Clarify the position once for all. The difference between secured and unsecured, the difference between financial and operational creditors. And it also is relevant for future lending in the country. Otherwise, after NCLAT judgment, that has become cloudy. People were not very clear when I am lending money, whether in future I will be treated as secured, unsecured, or if OC also has to get equal to me, then there is no guarantee that what I will recover. So from that perspective, it is very good.
All right. This also probably, opens the gates to the other resolutions that have been stuck until now, waiting for the resolution of the Essar Steel case. I just wanted to ask you, Mr. Bansal, just to put the correct numbers into perspective. What is it that Edelweiss ARC is going to be getting under the agreement or the arrangement of distribution by the COC?
See, we have bought debt from different banks and different entities. And as of now, we own about 19% debt. So whatever 19% has to get, it's about 7,600 crore or something. But that doesn't mean that Edelweiss ARC is, this is not a profit of ARC. This is the recovery of ARC on behalf of ARC as well as on behalf of banks. And also on behalf of funds who have co-invested with us in some of the deals.
Okay. So from an Edelweiss standpoint, you're saying this is not, additionally accretive in terms of the profit numbers. This is just what you are going to get back as a rebalance.
No, certainly the entire 7,000 cannot be profit.
No, of course,
It's a recovery.
Yes.
So there is a good amount of profit. The point is, as an ARC, we do get three things. We get a fees on our trust, whatever assets we manage. Then we also get 15% back. And then we get a recovery incentive. In some cases, it could be 4%, 5%. And then on top of it, we get upside. Because in many of these cases, we will get upside. Because we have started buying Essar Steel debt even at 50 cents. Initially, first debt which we bought from a private sector bank was at 50 cents. So let us say when you get 90, so naturally there is an upside also. So 80% of that upside normally goes to banks, 20% comes to ARs.
Mr. Bansal, out of the total debt that you just highlighted of Essar Steel, correct me, I think you mentioned somewhere about 7,600 crore. How much is recoverable for you all?
No, that's what I said. That's the total recovery for us.
Okay. And out of how much then, what was the exposure?
We have bought at about, I think, 5,500 crore or something at that point of time. But exposure is, see, this is equal to roughly 90% of what was the exposure. So exposure also has two different meanings, because when we bought the debt, let us say it was 100 rupees. That time, 100 now has become more because interest has got added till the time we filed the claim. So the 100 might have become 110 or 115. So then when we calculate 90% of that much we will get. So instead of 120 ka 90% means 108 we will get. So we may get more than principal also, regional principal.
Yeah. Well, Mr. Bansal, firstly, well, good news for the entire system and for you as well. So congratulations on that. Just wondering, the belief in certain quarters is that before the end of the calendar, creditors will be able to recover some of the monies. Would that be a fair estimate?
I have not seen the full judgment, but I presume judgment clears the resolution plan as approved by COC. Now, if that is the case, and as per the plan, it's a 5 days time given to ArcelorMittal to make the payment.
Right.
So we are in November, even if let's say 5 becomes 10. So I hope, unless there is some point which needs clarification or something, then it can get delayed. But I presume November itself we should be able to get the money.
November itself, okay, which is interesting. The other bit, Mr. Bansal, would be that the larger accounts which are being spoken about as also having a precedent in terms of a judgment now are the likes of Uttam Galva and a few others. Would Edelweiss ARC, what's the quantum of exposures that you have to some of the other large accounts, and would you now be hopeful of resolutions getting reached sooner rather than later?
See, this judgment has created problem for many cases. It's not related to only Uttam or bigger cases.
Yeah.
Because the COC's power itself was undermined by NCLAT.
Agree completely,
so
sir.
It's not only one case.
Yeah, but almost, I mean, I'm just saying the markets are really focused now on what will happen to some of those large accounts. So I agree.
Larger accounts wise, let us say if you see Alok, the one OC has filed a case, similar case. So that has got stuck up. Now if that OC case is almost clear by this Supreme Court judgment, so the NCLT or NCLAT can approve whatever plan is pending and they can dismiss that OC's case. So that can get expedited. Similar is a situation, I think, in Ruchi Soya, somebody has filed.
Yes.
So there are different cases. Then you have Bhushan Power and Steel. There are also some cases, OCs, pending. But then Bhushan Power and Steel, the additional problem of ED attaching the asset as a region. So there are different regions for different cases. But on an overall basis, if you ask me, these two things have created problem. One was a secured versus unsecured issue. There is a third issue also actually, which is creating problem. That also has to go on to Supreme Court, which is a so-called Piramal case, where the issue is whether if I file a case against the principal debtor, whether I can file a case against the guarantor. Yes. So there was one judgment which said you can't file against two, which is not correct legally.
Right. I think, Mr. Bansal, what my colleague was trying to ask you was as Edelweiss ARC, your exposure to some of these other accounts?
We have exposure to Bhushan Power and Steel. We have exposure to Amtek. We have exposure to Ruchi Soya. I don't have exposure in Uttam, so I can't comment on that.
All right, and the total exposure that you expect to get expedited on the back of this judgment would be, just if you could give us a figure on all of these accounts?
I don't remember exactly, but my feeling is Essar itself,
Was
there
the
are at
largest.
least 5 more cases linked to Essar.
Okay.
Because you have Essar Power Hazira, you have Essar Power Odisha, you have Bhandet Power, you have Odisha Slurry Pipeline. So that itself can give me another 2,000-3,000 crores. So that, I mean, it's a link to Essar group itself. And on top of it, then you have Ruchi Soya, Ocean Power and Steel.
That would aggregate to how much?
I don't know the exact figure as of now.
Okay.
All right.
This is good news for you, Mr. Bansal. Thank you so much for taking the time out, and all the best with the recoveries.
Thank you.
That's R.K. Bansal of Edelweiss ARC. The numbers are pretty strong for a lot of these firms, but it's very interesting because I remember not the on-air conversations, but off-air conversations with people, and they said that maybe, just maybe, the calendar year end could actually see some monies coming in. Here is Mr. R.K. Bansal saying that November, in the month of November itself, they'll get the monies in. So this should augur well. Let's wait and watch if it does. But all the stocks are doing very well. Now, a lot of people were wondering that why is it that Edelweiss as a stock is also doing so well. I think everybody was penciling in that $75 million funding from Sanaka Capital into Edelweiss. Maybe some of it could have been preempting a positive judgment on this front as well, because they stand to gain quite material, the ARC arm at least. 1 month, 75% uptake for Edelweiss Financial Services.
It had gone down to about 70 from there.
Yeah.
It's been just a one-way move on this.
Yeah, it's been beaten on badly as well, so no taking away that. But just that the last 9 or 10 trading sessions now that Edelweiss has been in the green, and 6 of them have been on an upper circuit. Actually, no, 5 of them now. Today is no longer a circuit. Okay, here our more market opinion. The share of India's consumption story as part of the GDP has peaked, according to CLSA's Mahesh Nandurkar. In an interaction with BloombergQuint earlier, he also spoke about how he's willing to pay a premium for certain pockets, or what he's wanting to pay a premium for. Here's a slice of that conversation.
My sense is that consumption as a share of GDP has probably peaked out, and the investments has bottomed out. And as investments begin to pick up, there will be a broader economic recovery. And when that broader recovery happens, it benefits everybody, including consumption. But that, I think, will be a second level impact and not the first level impact.
Okay, so like you identified housing as a theme in the last summit,
Right.
Is there a theme that you are tracking, maybe that's popped up on your radar, where you feel that this is going to be a turnaround story, or something which is anyways doing good but can do better?
Yeah, so my sense is that one of the new structural stories which has already emerged, I'm not saying that it has we discovered it only yesterday, but something that's already been playing out nicely for the last 3 to 6 months, maybe even a bit longer, is this whole non-lending financials. And what I mean by that is the life insurance, general insurance, asset managers. I think that is one segment of the market which has done well, but I think it can continue to do well for structural reasons and for a long time to come. So yes, valuation is a bit of a concern for that segment, but the fundamental business outlook is not a concern. So I'm happy to pay that premium for the long-term visibility on relatively higher 15-20% kind of a growth that we are expecting. So that is something that I would say is that makes us quite excited. And yeah.
That's the theme that we're tracking.
Yeah.
So, and you said that you're ready to even pay a premium to be part of that business.
Yeah.
But let's talk about, since we're talking about premium and on the index itself. Firstly, if you have any levels that you can share with us, and secondly, those 15 stocks which so far have been doing what they have been doing, leading to the index moving where it's at right now, is there a possibility of a bigger time correction? Because these stocks have just not corrected. I mean, they've just seen a one-way move. You've seen minor setbacks, but there are always buyers at lower levels for these kind of stocks.
Yeah.
So does that tell you? And growth for all of these stocks, barring a few of them, has actually not even been a CAGR of 10% in the last 9 years.
Yeah.
So what are we paying for?
I think what we are paying for at this point in time is the visibility, and the lack of growth in the other segments, of the market with that much predictability. I think that's what the market is telling you when certain stocks are even with that 10% kind of a growth which you mentioned, trading at 50, 60 times P multiple. I think that trend has changed a little bit over the last couple of months, and if you see, the leadership has actually changed in the last couple of months. Well, 2 months is not kind of a sufficient time period to confirm that something that has been happening for the last 7 years is changing. So we'll always need to wait and watch. But I think at least that small beginning is there. And for that change of trend that we've seen in the last 2 months, if that has to sustain, we really need to see the growth bottoming out and the investors getting better clarity and better sort of visibility on the earnings estimates, because they are still getting revised downwards. So I mean, if it wasn't for the big corporate tax cut that we saw 2 months back,
you would have had far many downgrades.
Exactly. So what that corporate tax cut has avoided or prevented is further reduction. So there hasn't been any upgrade, which ideally one would have expected. So that's what. So I think once that, I mean, as you said, the proof is in the pudding. So once that begins to be visible, I think this trend that we've seen for the last 2 months can then we say is becoming more sustainable.
All right, back to the markets then, and the index is holding pretty, about 0.5% plus on the Nifty, approaching 12,000. Let's see whether or not we can rescale that marker by the end of the show today. 11,955 is what you've got on the Nifty. Banks are supporting exceptionally well today. So after that big pullback yesterday, a follow-through has come in today's session, 400 points higher. Brijesh Singh of Stock Access is joining us on the show, and probably will be able to throw better light on how, what levels to track from here on the indices as well as individual stocks. And then Anand Tandon, independent market expert, is also joining us right now on the show. I'll come to you, Brijesh, first off, since we are looking at a lot more activity on the index now in the last 2 or 3 days. What's the sense in terms of the Nifty rescaling 12,000 and sustaining that versus the Nifty Bank, which has outdone itself in the last few days?
Well, from Devina, see, no doubt the Nifty from past couple of days there has been a volatility, and the strategy would be a buy on dip strategy. Now on the downside, the support which was somewhere around 11,820 or let's say 11,840 yesterday, that has been broken, but the smart recovery has been witnessed from yesterday, and still the momentum is been on the buyer side. Now immediately if Nifty give a closing about 11,940, then it would be more boosting for the bull side. Whereas on the higher side it's been concerned, 12,040 to 12,060 again would be acting as a resistance. So for a momentum play is been concerned, definitely one can go for a long side. Somewhere around, if Nifty give a small minor corrections towards 11,920 to 11,930 or say 925 zone, taking a Nifty spot value, one can go long with the strict stop loss of 11,880 and play for the target of 12,880.
Okay, that's on the index. What about individual stocks, Brijesh?
Stock, I have two stocks on a buy side. One is for a very short term play, and another is for a 2 weeks, 2 or 3 weeks time frame. The first buy call is Jindal Steel and Power. So on a weekly chart, we have witnessing the stock was been trading in downward channel slope, and now today's session it's been giving a confirmation the stock had broken out from the downward channel slope with increase in volume. So if someone wants to go long at the present rate of 144, 143, one can go long with the stop loss of 134. Therefore, the target of 175 is the time frame to hold would be 2 weeks. If someone wants to go for a month or so, then your stop loss would be a little bit deeper, somewhere around 123.5 or say 125, and the target would be extended to the level of 190. Second buy call is a Grasim. On a shorter term time frame of the chart, this stock had been trading with higher tops and higher bottom formation, with the volume increase, with the oscillators giving a buy signal. So somewhere around 759 or 760 the stock has been quoting. Present rate can be used for accumulation purpose with the stop loss of 742 for the target of 788. Time frame to hold this counter would be a 1 week.
Okay, those are some stock-specific ideas coming in from Brijesh. He gave a buy on Grasim. By the way, Ultratech has moved higher in today's session. It's up about 2% in trade. And while we highlighted the telecom stocks, how Idea, after touching lows of 2.5, I know it's a penny stock, and it's quite surprising for a penny stock. It's still there in the futures and options market, and the stock is now up about 28 to 29%, giving more room for traders to take a bet here. All right. Anand, hi, good afternoon, and thanks a lot for joining us. Besides the most important case which was listed at Supreme Court, one of that was the Essar Steel, where the verdict has been in favor of the Committee of Creditors. The other space, first I want to take your view on, is the Pharma pack. There are a lot of stocks buzzing around, and this is a space which is not doing too well in the last few years. We've got Glenmark, which posted better than expected numbers. The operating performance was good. We've seen API business of that company growing by 7%, and of course good news coming in for Divi's Laboratories too, where inspection at Unit 1 concluded with no observation. Your takeaways looking at the numbers, and do you see any sort of growth potential from here at current levels in the pharma stocks?
I think pharma generally has been doing well, except in the stock markets, largely on account of the fact that the US market is the one that is giving trouble with a lot of uncertainty surrounding which particular person comes and actually does the inspection. There are a few who are particularly nasty in their processes, and some who are not so. So that has made it a bit of a toss-up in terms of whether you will get 483s with some negative comments or not. However, aside from that, many of the companies have been de-risking themselves by trying to move into other regulated markets. And the portfolio in terms of Europe, etc., is robust with many companies. Importantly, areas like China are now beginning to open up as well, with, for example, Dr. Reddy's showing tremendous traction, and India again has come back to double-digit growth. So all in all, except for the major market of US, by and large the sector is reasonably poised, and US after all cannot do without drugs from India. It's only a question that you have to keep a track of the volatility that comes because of regulatory action. Valuations have corrected so steeply that most of these companies are now trading at 1-time forecast PE, which is not particularly challenging. And the Indian market growth has been reasonable enough even for some of the MNCs to start doing well. All in all, I think it's a sector which is under-owned, where the performance, though patchy, has been not as bad as the market would tend to think, and it's certainly an investable area.
Okay. That is a quick take firstly on the pharma space that we were discussing. Aside from that, for banks, Anand, and primarily the PSU banks, which have got which can breathe a sigh of relief now on the back of this favorable court case hearing by the Supreme Court. Do you feel that more resolutions now mean that the risk appetite, even from an equity standpoint, could return to some of these PSUs? And SBI left aside, because that's the only one that people keep talking about from the PSU space. But I'm talking about the smaller ones, which also will start to see money coming back.
I think you will get some near-term uptick in almost all the banks, because there will be some payback from Essar for many of them. But that said, don't forget that these banks have a great ability of spotting all future NPAs and making sure they are party to it. So all you're doing is, by recapitalizing them, is that you are making sure that we are now able to spot the next bunch of NPAs more clearly. Other than the fact that they will probably go back to trading at book value for a little while, there is nothing which has changed substantially in terms of their governance or the quality of credit evaluation or their cost of capital, which leads one to believe that they'll be able to gain back market share from the private sector. So the longer term theme continues to remain that look for good, well-managed banks in the private sector, which are going to benefit from whatever cycle. The cigar butt investing approach, of course, will bring you back to some public sector banks, where because they've been thrashed out of shape, and because someone is willing to put in a bag loads of money even now, for some time their book value will go up, and since they are trading at less than book value, and they now have the ability to go back and lend again, there will be a reason to start looking at the numbers all over again. So you will get some upside on the public sector banks. Some, when I say, could be as much as 100% from here, but it is not a strategic position that you can hold on to a portfolio and go to sleep peacefully on.
Probably just take profits as they come if you're invested into PSU banks. But, since we're on that topic and we mentioned Edelweiss, Brijesh would like a chart check from you on the stock after a 75% bump up in the last 1 month. Can one take profits, or do you see further upside?
See, if I talk about the Edelweiss, the stock right now quoting at 131, and the stock had given a bounce from a level of 175. Still, there is more stream left on the higher side till stock trades above 115 or 117 zone. But at this juncture of time, I would be avoiding. If someone has been long, then I'll say keep a stop loss of 137, 117 around. And if someone wants to go on a fresh long side, I'll suggest if it trades somewhere around 122 to 125 zone, one can go long with the stop loss 117. Whereas on the higher side, it's been concerned 145 to 148 is a resistance zone where we can see stock trading in a couple of weeks time frame.
Okay, that's Edelweiss, which has recovered quite sharply from its lows that we had seen in the last 1 month. The stock has gained a lot. Bharti Airtel, Bharti Infratel, both of them have rallied today, and the gains are quite sharp. Airtel almost at the high point of the day. Remember, 400 is the mark that probably on the trading front, at least that's what the options data are indicating, will be the first resistance. But Anand, come in here. The numbers operationally, at least for Bharti Airtel, looked better. The margins were higher than what the street was expecting. They did manage to add subscribers also for the quarter gone by. Of course, the overhang remains with regard to the AGR dues that they have to pay. Highly leveraged company. Also remains to be seen the mode they use for repayment of these dues now. For a shareholder of Bharti Airtel, a stock may have gone up at least this year, but in the last 5 years, it's not given any returns. What would your advice be?
Well, there's no particular reason to change your view. At the end of the day, as you mentioned, it remains highly leveraged and totally at the mercy of the government. Even today, the real issue is how will the government allow them more breathing space so that they can generate enough money and give it back to the government. So essentially what you're doing is you're earning money to pay the government its dues, and whatever is left over, if anything, is then going to come to the shareholders. You will end up having to perhaps raise more debt. So the payout to the shareholders will be even lesser if there is any at all. And then don't forget that there is something called a 5G, which is likely to come in, where willy-nilly all the companies will participate. And if the 5G auction were to come through, there is not yet any kind of app that or any kind of application of 5G that one can see which will induce people to pay more money. So you'll end up paying another slug of money to the government for getting licenses, which will then be marketed at a similar price. By and large, as a consumer, you should enjoy telecom and don't bother about investing in it.
Okay. Don't bother investing in telecom. At least some sigh of relief in today's session if somebody would have taken a long call yesterday, because the stock was falling in the last two sessions. Bharti Airtel, at least that trader will be sitting with some amount of profit.
Let me. Guy who went short.
Oh, yep. And yeah, there were actually short positions seen yesterday, but I'm sure they must have been wiped out. Let me quickly get a technical check. Brijesh, 393. What would you suggest doing here? If somebody was lucky enough to create a long position at lower levels, is it time to book profit, or it's headed for further upside?
See, Navneet, it has a 52-week high somewhere on 397, and with the increase in volume, it indicates the party is not over for a short-term trading bet has been concerned. Even for a VTST, I would be suggesting till stock trades above 386 or 387, one can go long and look for the target of 405 or even 410.
Brijesh, while obviously the fundamentals and news flow are surrounding the interest in SBI, which is up 25% in the last 1 month, would you say that probably, like the rest of the pack, maybe look to take some profits off even for an SBI?
Even a stock had a resistance, multiple resistance in the range of 324 to 328. So if someone has gone long, I would be suggesting at the present rate of 322 or say 323, the stock has been quoting. Definitely one can go long. Fresh long position would be avoided. If someone wants to go long, then the ideally for the risk reward ratio has been concerned 312 to 314 is a range. Then again one can go long in it. But stock has to give closing about 327 for the next rally on the higher side.
The other pocket, obviously, that suddenly, we've seen some amount of disinterest of sorts has been the technology space, at least on the fundamental side, commentary with regards to slowdown from the US, which could impact the earnings potential for some of the IT majors going forward into the next few years, is leading to some amount of, comments on how stocks like Infosys, HCL Tech, and even the smaller names like Emphasis or Hexaware for that matter, may not land up being wealth creators from a medium-term standpoint. Do you agree with that, Anand? Do you feel that probably IT is not the pocket that could give you those medium-term returns?
Well, I disagree. I think it's one of the sectors where there is slow and steady growth, and every now and then you will get a slug of earnings upside, largely because of the fact that the rupee will depreciate. Please understand, the economy is in a tailspin. Right now, the government is desperately looking for clutching out straws, trying to make sure that we can get up to some speed so that it can take off. If those measures are successful, great, everything else will also move up. If they are not, you are looking at a fairly steep pressure coming back on the rupee, and that will mean that anything which exports is great news. So from a portfolio perspective, even if nothing else but as an insurance, you should not be underweight IT in my view. And from a growth perspective, there are actually many of the smaller companies which are growing far more robustly than the frontline companies, especially the product companies. So pick and choose your stocks, but even otherwise, I think from a services perspective, I think it's not as if, barring perhaps TCS, which looks a little expensive, most of them are not particularly expensive either, and will continue to give you close to double digit or if not more kind of growth, and in rupee terms, almost definitely more than that. So, there may be some euphoria around some news every now and then, but this should be part of your portfolio, at least as a kind of market neutral position.
Okay. Anand, good afternoon. We've spoken at length about what's happening to the two listed asset managers. I want to leave that conversation out. Everybody now knows about HDFC and RNAM. What about the second rung? Because that started to inch up as well. I mean, any kind of wealth management. IIFL Wealth is on a roll. Motilal Oswal, the listed entity, which is now largely being prescribed the AMC valuations, is doing very, very well for itself. And there are some other companies which have got those embedded asset management businesses in place. Aditya Birla Capital, for example. Do you have any thoughts here?
First of all, the asset managers in India are grossly overpriced. Let us be very clear on that they are priced at maybe 5-10 times perhaps what the international peers are. So if you like asset management companies, you may be better off buying their partners globally rather than buying the companies in India. That's one off. But given the fact that people love India and you all want to be in the wealth management space, the wealth managers are not the ones who are actually going to be making the kind of money that the asset managers are making. The argument is that the asset managers have a business which scales without increasing cost. That is not true with wealth managers. Please understand that the wealth managers are basically people who are going to gouge you for your returns by making sure that you put money in the most expensive products because they can get a fee out of it. So therefore, from a perspective of someone who's trying to actually put money into it, using a wealth manager is the best way to destroy it. In that context, do you want to be buying a company at a huge premium is the question that you have to ask yourself. Also, given the fact that the margins are far more constrained and they are not linear, unlike that of the asset managers. So asset management, great business, wealth management, far more challenging. On the asset management side, very, very expensive. Buy BlackRock in the US.
Well, Anand, so two counter questions. One, I mean, you need to account it's Stockal or some of the others to be able to do that. A lot of retailers don't have the chance to do that. Part two, even if the asset managers, and just a theory, even if the asset manager is making me put my money in a scheme which will make the asset manager earn money, it'll still give me better returns than my fixed deposit, and therefore net the investor will be better off. Won't this whole financialization of savings theme work in favor of the asset managers in India?
So I think, Neeraj, you are confusing the asset manager and the wealth manager. As I said, between the two, there is no question that the asset management business is far better and will eventually and will continue to grow, though I don't think that you can assume that the kind of 18-20% growth we've seen over the last few years will continue forever. But you can at least assume double-digit growth for a long period of time. I think that part can be a given. The question then is whether or not that is something that you should be, what is the value you want to put it in. From an investor's perspective, the only thing you should be doing is buying mutual funds. I mean, all kinds of AIFs, etc. there is no logic why you should be paying the kind of taxes that they are going to be exposing yourself to for a product which is largely undifferentiated from what a mutual fund can offer. And that too with a lock-in period and a much higher payout, the chances are that your returns, even if they were to be reasonably different, will come at a risk which is far more than you are assuming that you are taking, and post-tax may not be very much different or even perhaps lower than what a plain vanilla mutual fund will do. Please understand, wealth management is an ego business. You want to have somebody you want to talk with. It's not something that is going to help you make money.
Yeah, no, fine. I somehow misunderstood what you were trying to say, but fair point. Okay, the other question, Anand, is what's happening with the pharma space. I know you spoke about one company which came out with results. The last few days, we've seen most of the pharma stocks take a beating, save for maybe an IPCA and a couple of others. Are they in the zone wherein you would be tempted to buy them, or would you leave that pack alone because of the uncertainties?
Well, as I said, it's not been a space which has done very well. So the best way of doing it is to actually buy one of the mutual funds which are focusing on this sector and keep nibbling away at it, because all said and done, most of them are reasonably cheap. And they will cycle out at various times. So you will, unfortunately, because of the fact that our biggest market, which was the US market, has become a lot more complicated because of FDA action and consistent inability of Indian companies to be able to deal with it. It has become a bit of a lottery. So the best way of doing it is to look at a basket rather than trying to do cherry picking, unless you have extreme understanding of the sector. Now, within that, of course, I think, a company like, for example, Divi's is likely to do reasonably well, but it is trading at 33 times. So the whole market knows that. Probably a Natco will do well a year and a half down the road. Aurobindo is well positioned, except for the fact that we don't know what is going to happen. What is the real impact of the recent 483s that have come out? And if that impact is not as significant as the market thinks it is, or can be sorted out quickly, well, that's a stock which is trading at almost single-digit PE. So, you have different risk returns in each of them. As I said, unless you are an experienced investor in terms of the pharma sector, best to go with the mutual fund. And the important thing is, again, I would argue that it's not a space that you should ignore. May not be very heavily overweight, but at least 5 to 6% of the portfolio needs to be in that.
Okay, that's the view coming in on the pharma space, which is actually bucking the trend today. As you saw, Nifty Pharma Index is up in about 2%, and most of the constituents in that index have been sitting with good amount of gains. I think barring Dr. Reddy's, which is not doing too much in today's session, gains being led by Glenmark, Divi's, Oro Pharma, which was down sharply, has seen some bit of recovery coming by. Pull up Cholamandalam Investment. We highlighted the stock at the start of the show. The stock's touched 52-week high, good gains seen for this one. In fact, the data also suggesting there is a lot of cash-based buying at nearly 60% of the traded quantity so far has been marked for delivery. And then coming here on the NBFC space, we've seen some good numbers in a tough environment. The gold financing companies have been moving higher post the numbers. Cholamandalam posted AUM growth of somewhere about 28% despite of liquidity challenges and slowdown in the CV space. Do you think one can make money now in this space?
It's simpler to just buy some of the corporate facing banks if you have to be in the banking space, but an ICICI Bank is still probably a better place to be. If you are looking at NBFCs, clearly I would continue to favor those where there are fewer issues in terms of quality of management and equally fewer issues in terms of having management which can put in more money. So the corporate, the NBFCs which are backed by large corporate houses are likely to do better. And the best part would be to stay away from those which are doing real estate, because we haven't seen the possibilities that could come out there in terms of government action beyond the announcement of some fund. The reality is that is the part that will find it most difficult to continue to raise money and therefore grow. The ones that are backed by corporates have, and those which have shown growth in this tough environment, certainly one could be looking at them as possible investments.
Anand, always a pleasure having you. Thanks so much for taking the time out. I don't know if too many wealth managers or portfolio managers will be happy hearing this conversation, but nevertheless, we like to call a spade a spade. Good having you. Thanks so much.
Thanks, Neeraj.
That's the view from Anand Tandon. Pritesh Mehta, I'm told, of Yes Securities joins us on the show as well. Pritesh, good having you. Thanks for joining in. Let's start off with your stock ideas first, Pritesh, and then we'll get to the other conversations. What are the two stocks that you're recommending in the session today?
I have one buy recommendation and one sell recommendation. Now see, the first one is the buy on Tata Chemical. See, post a prolonged corrective phase which was in place in September 2018, the stock marked a bottom around in the month of August around the levels of 540. Thereafter it created a base, and in the process it gave a breakout from a downslope trend line, and in the process also overcame the 3-digit GAN number 625. Now it is facing hurdles around the multiple peaks of 640, 650. When that is taken out, we could see swift up move in this counter. So buy for target of 700. And second recommendation is HUL. See, we have gone through the ratio chart of HUL against the Nifty Consumption Index, HUL against the Nifty FMCG basket. Now this particular counter commands high weightage in both these indices, and the story is clear. This stock in both these indices appears to be topping out. So we saw a price confirmation taking place in last week's trade. Ratio confirmation was already there 2 weeks back. So I think that could be a more downside in this counter. We can see levels of 1980 going ahead.
Okay. So those are a couple of names from Pritesh's, and do watch out for HUL as well. I think second time in 2 days that I've heard about a short call on HUL. Let's wait and watch. The one which is posting some very strong gains over the last few days, and not just today's HDFC Bank. You might argue that this 0.71% move doesn't look to be too much, but look at the price of 1282 and look at where it is from compared to what it was just a few days back. I think HDFC Bank over the last around 4 or 5 trading sessions has inched up about 7%, and this is the big one, safe, steady mover. Any point of time you bought it in the last 1 month, you made money. Is there a trade possible here is the question. Pritesh, at 1283, would you buy into HDFC Bank afresh?
Definitely, because if you look at the relative strength charts, I see private banks doing extremely well, and you have to focus on large cap private banks. Something like ICICI Bank has already done well. Axis Bank has not participated in the move. In fact, the current leg of move, ICICI Bank has been the sole driver of the market. But HDFC Bank and Axis Bank has a lot of ground to catch up. On a standalone basis, HDFC Bank on a PNF chart has given a multi-column breakout. We can also see double top diagonal breakout. So I think there could be 4 to 5% fresh upside possible in this counter. And if I look at HDFC Bank and compare it with Bank Nifty Index, it went through a period of correction. The ratio has bounced back. It is telling me this stock could outperform the Bank Nifty Index. So I think HDFC Bank is definitely a buy this level.
Okay, that's HDFC Bank for you. But moving on, CLSA is underweight on India. In the emerging markets basket, Chief Strategist Adrian Mowat believes that while investors are favoring other EMs to India to park their funds, a couple of economic surprises can turn the tide in India's favor. Listen in.
I think it's back to what are the opportunities for the domestic investor. So the domestic investor has generally been rewarded by buying the equity markets. And they do it in a very consistent way, and you can see it through the inflows into SIPs. Our forecast is that interest rates will be falling globally, including in India. You typically get a pickup in demand for mutual funds as fixed deposit rates fall. So I think the cash flow dynamics for the equity market, will you get net demand, look quite good just based upon the domestic investor. When I step back and look at the Indian situation versus some opportunities I've got elsewhere, what we're seeing in North Asia is some very high growth stories, some positive earnings revisions. So they're coming through in the semiconductor space, which is a very large part of the benchmark in Korea and Taiwan. In Taiwan,
you're overweight in Korea.
We are overweight Korea, Taiwan, and that's really driven by the tech story. So we've got a big pickup in earnings growth in tech as the semi-cycle turns. Earnings revisions are positive. I think valuations are attractive. So that's where I think you're going to see the leading performance in emerging markets. Then if we look at China, there's some very high growth sectors in China like e-commerce. So e-commerce and the consumer discretionary sector of China is 7.9% of the total emerging market benchmark. That's almost the same weighting as India as a whole country. And so these are the opportunities, and so this is where we're advising clients to be overweight if they want to outperform the emerging market indices. And then we're funding that with an underweight in India and in the ASEAN region. I think you will be making money in India and the ASEAN region, but in the first half of 2020, I think you'll make more money in North Asia.
So let's talk about that underweight on India.
Yeah.
I mean, we've seen Moody's change their outlook as well. They've probably, brought it at par with what the other rating agencies have done. But your reasoning for the underweight on India, and how long can this continue?
So my reasoning is I can make more money elsewhere.
Okay.
Right? And people often misunderstand an overweight and an underweight as a proxy for buy or sell, or a statement that if you're underweight, the market's going down. I'm advising investors in emerging markets or Asia Pacific ex-Japan benchmark on how to outperform their benchmark. So where do I get the higher return? And as I look at it, we're going to get the higher return in North Asia. Now, it's quite possible that often happens in stock markets is the discounting is very rapid.
Yeah.
And so, if Korea and Taiwan outperform considerably over the next quarter, then we may be reviewing the situation and thinking about relative returns for the balance of the year. And so that could result in money flowing back into India without any changes in the underlying fundamental dynamics of India. Now, what would encourage investors to come back here would be positive economic surprises. So evidence that the corporate tax cuts led to a pickup in business investment. I think that would be a very positive sign. If the government can do a little bit more to boost household real income, particularly in the rural sector. So we've had very low increases in the minimum support price. So yes, the agricultural sector has become more efficient. Output in terms of volume of agricultural products have gone up, but the pricing effect that they used to enjoy is much more modest. And we can see in the anecdotal data that rural demand is quite weak. The other area we need to think about is urban job creation. India doesn't have particularly robust statistics around employment and consumption. And so we're reliant on anecdotes. And unfortunately, a big employer, which is the auto industry and auto ancillaries, according to the Automobile Association of India, 5 million contract workers, about 10% of them have lost their jobs this year.
Yeah.
And so we'd like to see a turnaround in manufacturing employment. See an increase in service sector employment so that you can see a boost in real urban household income. Because remember, India is a consumption economy.
Yes.
It's not an export economy. It hasn't been a manufacturing economy. And so you always need to go back to what's happening at the household level, because that'll determine your growth rate through consumption.
We're talking to Mahesh as well. Last year's theme was real estate, and he said that it's going to continue to do well. What else do you feel one can look at from an overweight standpoint within India? Any sectors?
Yeah, so I think, I showed a slide in my presentation which was just looking at how consistent stocks appear in the top 10 in the Nifty over the last 11 years. And it's to some extent, India remains a run your winners story. So you remain in your key private sector banks, private sector NBFCs that are doing well. That is the story. It's a portfolio that doesn't change
Pay a
very
little
much.
more, but we'll keep you safe.
Yeah. Well, they have compounded at a pretty decent growth rate. And yes, they look expensive, but in a world where growth is in chronic short supply, a consistent growth company, deserves a premium.
Okay, that's the word coming in from Adrian Mowat of CLSA, talking about the flows and how Indian markets can be expensive. But remember, we've seen some FI money coming back into our markets. This month itself, almost 4,500 crore, and last month also we did see an inflow of about 8,500 crore. On that note, well, markets are still holding on to its gains. Nifty's trading has been trading for majority of the session rather above the mark of 11,900, though we've come off, by the way, from the high point of the day. Bank Nifty holding on to levels of 31,000. Let's find out then which are the Fab 4 stocks that feature in Sharad Dubey's list. Let's go across to him. Hi Sharad, good afternoon.
Good afternoon, Navneet. It's Pharma and financial financials this time in the pack. The first one being Corporation Bank. The stock is up almost 17%, seeing its biggest intraday gain in 9 months. So basically, the Supreme Court has actually delivered the verdict that the distribution of funds will be there as per the Committee of Creditors for the Essar Steel insolvency. So the bank is having 100% provisioning of an amount of almost more than 1,500 crores, which will be written back. So that is something which we will be watching out for, as the bank itself had a 130 crore loss for this quarter. So that is something which will be positive. Up next is Divis Labs, which is up almost 5.5% after it received 0 Form 83 observations for inspection in its Telangana plant. So this was a general manufacturing practices inspection which lasted from November 11th to November 15th. Up next is Glenmark Pharma again, which is rising almost 7% up and seeing its biggest intraday gain in almost 4 years after it reported a good set of numbers with revenue growth, a healthy revenue growth coming across various segments, and the API business going of India as high as almost 15.2%, and even the receivable and the inventory days were solid for the balance sheet numbers. And the last stock is Cholamandalam, which is up 6.2% as we see fresh longs and see a high open interest of more than 36%, and the volumes trading at 2.5 times its 20-day average. Back to you.
All right. Thanks a lot for that, Sharath. So do watch out for some of those names. Could be doing well. What else is doing well? I'm just looking at stocks which are trading near their 52-week highs. Included Cholamandalam Investment, 6.5%. We spoke about it. There is SRF, which at 3214 is doing well. Credit Access Grameen with about a 4% gain is doing well. And Bharti Airtel is trading at 52-week highs, so doing well for itself. So a good set of names out there. Dixon Technologies is doing well too, 3276. The stock is packing a serious punch for itself. Okay, we should be getting our next fundamental guest on the show in a moment from now. Rahul Arora of Nirmal Bang Securities will be with us to talk about his thoughts. Rahul, good having you. Thanks much for joining in. I want to cut straight to the chase, Rahul. In your brokerage house, have you guys penciled in a higher recovery rate and therefore maybe some investment case into the banking names after the verdict today?
So thanks for having me, Neeraj. I think it's the Essar ruling, of course, was a shot in the arm. But I think with that out of the way, I think the focus is now shifting to how the issue on the telecom side will pan out. And I think I was very surprised to see the stock reactions on Bharti and Vodafone on opening today. But I think there's probably going to be a bit of a moratorium and a sort of a staggered payout is what we're getting to here. If that happens and these telecom companies say over a 20-year period have to pay out 2,000 to 3,000 crores per year, I think the strain on the cash flows will be much lesser. Conversely, their capex plans will definitely come down. So I don't know what it would mean from an earnings standpoint on the return on equity that they would generate for shareholders. But I think definitely if it moves in that direction, I think it's more positive for the public sector banks specifically, where they're battling a lot of other accounts where they don't have substantial collateral and things like that. It may also push back capital raising for some of the banks. For some of the banks that are in urgent need of cash or capital, if they start getting payments, I think if they're able to shore up their Tier 1 ratios, I think it could push back. I think, of course, the biggest exposure that pretty much would be across the board would be names like State Bank of India, Bank of India would probably be two names at least that figure up consistently. And then you may have some of the other smaller ones that fit in. So I don't think it's a bad time to be taking a trade in on State Bank of India particularly. The others, I think I'm not entirely convinced right now. And on the corporate side, I think if these recoveries start to happen, I think some of the names that have been beaten out of shape, maybe a Yes Bank or an RBL or an IndusInd Bank, they may not be some bad names to bet on as well right now. So I think this could be the start of something for the banking sector. But I still probably would, wait to hazard an out-and-out overweight call on the banks, because I think our own economist is penciling a 4.8% GDP growth for the quarter gone by. So if the growth rates are going to come down, lending growth is not going to happen. At some point, I think with the other issue that banks will have to contend with is retail NPAs. It's not being spoken about to that length just yet, but I think at some point it will emerge. So I think for the moment the bank nifty looks all right. I wouldn't be surprised if it heads up to 31,000 in the not too distant future, maybe even higher than that. But I think it's probably a more measured approach that one would have to take. I think it'll still probably be, the trade might still be more towards the Kotaks, the ICICIs, the HDFCs of the world, and I think these will probably be more event-based plays, if anything.
Okay. The other set of names which have done well in the last few weeks, Rahul, are all these internet-based companies, right? Everything which has got some technology powering them, new listings, different business models, Apple, so on and so forth. Do you guys have any coverage on any of these newer listings and any bull calls here?
No, nothing, Neeraj. From the recent listings, IRCTC seems to have done pretty well. The results were also holding up all right. We're taking a look at it. I think it's an interesting stock. I think our retail team probably does definitely cover it, but not too much by way of the recent listings from what we've looked at. I think probably the next one that we look at is probably Burger King. I think because we look at Jubilant and Westlife very closely. They filed their DRHP not too long back. So I think depending.
Do you think
on
there's a valuation catch-up play out there for the two listed players right now because of whatever valuations Burger King might be coming out?
It could be because Burger King is actually a loss-making entity. So it's actually a 40 crore loss on the bottom line, and it'll be interesting to see what kind of multiples that they come in at and whether they're actually valued on a price to earnings or an EV to EBITDA. Because when we talk to institutional investors, they're happy talking PE in the case of Jubilant FoodWorks, but they probably want to look at EV EBITDA more in the case of Westlife, because obviously there is a debt component that comes in. So we'll have to see what the model is for Burger King going forward. I mean, there are not that many stores right now. I think there are 200 stores on a pan-India basis. McDonald's is 500 just in West and South, the listed entity. So I think there is some catching up to do in terms of capex, and I think that's probably one of the reasons they're coming out. But if they get a reasonable valuation, I think Westlife is probably a better case to be made for than maybe a Jubilant FoodWorks just on the Burger King listing. But it's going to be an interesting space. I mean, I'm actually quite thrilled and waiting for it.
Are you not worried about the competition these players are facing because of the food aggregators, Zomato, Swiggy?
So I think, in the case of McDonald's, for example, if you go back 4 or 5 years back, they weren't even delivering. So I think delivery today is about 15-20% of their sales. So I think if anything, it's a brand extension. I don't view it as a cannibalizing effect, because if somebody wants to have a McDonald's, they will have a McDonald's. And I think the frequency of consumption is really not that high. And I think probably at a slightly lesser level where McDonald's probably scores over a Jubilant FoodWorks is they get you in at breakfast and they take you till after dinner. I think so that spectrum
That's okay. Domino's is delivering till 1 a.m. or 3 a.m.
Yeah, but it's not. It's only a lunch or a dinner product.
Right.
The point I'm trying to make is you can actually walk into a McDonald's at 7:30 in the morning and consume, and then you can go to them for desserts after dinner. So it's pretty much an all-day dining concept that they have. So I think to that extent, I'm not too fussed about the Swiggies and Zomatos. I think actually they would expand the business pie. And in fact, if I'm not mistaken, a lot of McDonald's delivery boys are actually outsourced. So these may be actually the McDonald's that you get at your residence may actually be getting delivered to you via a Swiggy or other platforms, Scootsies of the world, to that effect. So I don't think it is a cannibalizing effect. I think it's more a business expansion effect. And just a case in point, I think if you look at the last maybe 7 or 8 years running, I don't think Domino's has reported a negative SSG in the United States. For about 7-8 years running now. I think it's almost 30 quarters that they've reported a positive SSG. So if that market is not saturated, I don't see how the Indian market, I don't think we've scratched the surface there. So.
Okay, but of course for the September quarter, Rahul, they did surprise on the same-store sales growth numbers. Sequentially, there was a bump-up seen for both. Within the same space, Page Industries came out with the numbers. Some bit of dilution, or rather you did see the margins coming off a bit, but they have maintained their margin guidance of about 21%. The stock's already recovered from those lows of 18,000. Valuation still expensive. If you guys have coverage, what did you make of the numbers?
So we don't specifically cover Page, but I think it's very interesting. I mean, I was trying to look at the consumption basket, the Indian economy, the stock markets, and I think there is no correlation anywhere. Because if India is growing at 4.8 or 5%, you can't have durables and electricals and multiplexes giving you the kind of numbers that they are, because these guys are just growing at a different level altogether. I mean, I'm not too worried about a Britannia or a Lever, for example. I mean, just sort of going one level higher than Page Industries also, reporting 3 to 5% volume growth at that base. I'm not too fussed about it. So the consumption slowdown is actually that we hear about from an economic standpoint is actually not showing up in the corporate results, which are actually quite different.
Correct.
The only thing I can think of is that the auto slowdown that we've seen over the last few years, where people have cut back on the auto spending and EMIs, that money is still in the hands of people. and that has to go somewhere. So I think that's probably found its way into consumption-related stocks at a greater velocity of consumption, because if people are going to rent real estate and they're going to go into shared mobility, for someone who's say making even ₹1 lakh a month at 12 lakh rupees, he still has that money to spend. So he's got to spend it somewhere. So I think that's probably going into a different basket of consumption. I may be wrong, but there's no other way to explain that your economy is growing at 4.5–5%, but these guys are continuing to give you 15–20% earnings growth. And I'm saying even if you take out the tax effect, it's not that everyone's gone to the new tax rate. Some of the consumer companies, because of MAT credit, has still not done it. And so even if you just look at the operating level, it's actually been quite decent. So I'm trying to make sense of it. I can't, but names like Page, Lever, Nestle, I don't see people selling them unless there is a very compelling reason. The question is, if I sell them, do I want to buy a Maruti? Do I want to buy a BHEL? Do I want to buy a State Bank of India? I mean, you need a very compelling reason to sell a Nestle or a Lever or a Britannia and then buy something else.
Okay. Now, hang on to that thought. Lots more to talk about as well, but I think we should get a sense of what dealing rooms are recommending as well. So, should get in Darshan in just moments from now to try and talk about that. Keep in mind, important day of trade simply because the Nifty Bank is still holding out very, very firm. Just that the Nifty and the Sensex have cooled off a little bit from the highs of the day. So, let's take it to Darshan. Oh, Johnson right now. Okay, should we go across to Darshan? We can go across to Darshan. Darshan, what is it they're gathering from your sources?
Yeah, so spoke to a couple of dealing rooms. I think Cholamandalam Finance is something that a couple of dealing rooms did indicate. Numbers were good, trading at a 52-week high. They believe that the momentum will continue. Among the larger banks, there is accumulation that's happening both on ICICI Bank as well as Axis Bank. So dealers indicate that some of the domestic funds are active on these two banks. So that is something that's been spoken about. And finally, these are the two ones. And finally, Bharti Airtel has had a stellar run today. No doubt, operationally, despite the loss, operationally it was very, very strong. Some of the dealing rooms indicate that now they have much more clarity on what the final fee will be, and it's come in much lower than what was anticipated. The AGR fee that was anticipated, somewhere even saying anywhere between 40,000 crores, so it's much lower than that. So there is definite clarity to what happens next for Bharti Airtel, and on an operational strong numbers, there have been some of the foreign funds which have taken positions in Bharti Airtel today.
Right, Darshan, thanks very much for that. So that's what we've got in terms of our dealing room check this afternoon. I actually wanted to pull on that point of yours, since we were talking about consumption, Rahul. One particular space, paints, grows at 1.5 to 2 times GDP growth. And we're talking about a GDP growth of 4.8%. Still these kind of growth levels of, 10 to 15% for Asian Paints as well as Berger. Sustainable?
Even if they come off a bit, I wouldn't be too fussed about it because there's a huge replacement demand story to be played there. So even if I have...
that person who runs the EMI, who has that money, is going to use that money to redecorate?
At some point, you will refurbish your house. So there is a replacement demand. It probably happens once in 5 years or 7 years. So to that extent, at least, even if I'm not having sales of incremental houses, I know that my business is not going to stop. The other is you need to differentiate between residential paints, industrial paints and automotive paints. I think in all of these baskets, there are players who overlap to a large extent. I don't think if
it is towards
absolutely,
autos, yeah.
Absolutely. So I think even if the growth rates if were to drop down to high single digits from the double digits, I'm not saying, of course, a couple of quarters back, Asian Paints had almost a 17–18% kind of growth on the volume side. I think that is definitely going to temper itself. But I think. So the way to look at it is, I think in the current inflation and interest rate environment, people need to moderate their expectations on what these companies need to deliver. Yeah. So if I was dealing with a 9–10% inflation and a very similar interest rate, I was probably looking at, say, maybe a 3x on ROE to that effect. So if I was obsessed with the 25–30% ROE, today if I have inflation and interest rates at 5%, I should be okay with the company at a 15–20% ROE as well. And if I have something that's giving me a 15–20% ROE, it's reasonable to expect that the earnings growth is somewhere in the mid-teens also. If my earnings growth is in the mid-teens and I'm not getting that much by way of volume growth, that means I'm getting fair amount of operating leverage, which means I'm managing my costs well. So if I was, and I'm working backwards here, so if I just, through this logic, if I take it back to an 8 to 10% volume growth also, I don't think the valuations will derate to such a large extent, is my view, because in capital goods, for example, you're still seeing working capitals, cycles
but
elongate.
But 80 times doesn't look too glossy for you?
So Devina, the point is you're getting 8,000 crores of SIP money on a monthly basis. As a fund manager today, you're right, and you take most of the successful mid-cap fund managers in India over the last 1 year, they are buying what they know best. So it is basically money chasing that few stocks. So I think multiple is not a function of the earnings that they're delivering. It is just that fund manager, I'll give you a classical example. I had a call with a fund manager this morning. At about 8:30, and the reason I got that call was he suddenly realized that Bata had become 4% of his portfolio, and he didn't even realize that, and he's like, I just want to know what to do with it. So the problem is that, you know, if you're so used to buying something, it becomes that big of your portfolio, and then suddenly sometimes you realize that if I sell it, I'm going to have an impact price on the stock, so you don't know what to do with it. So which is why I was going back to the earlier point that you need to have a very compelling reason to sell a consumer stock today, and buy what? Because even a BHEL contractor today is getting payments delayed by anywhere between 6 months to a year, and the working capital cycle is very stretched for anything on the manufacturing side. Autos is pretty much the same thing. You know, people are not getting payments done. I'm not saying that the growth rates in consumer won't slow down. There is a disruption. You guys must have read that there is a tussle on between the distributors as well as the manufacturers right now. It could have a transient impact on growth. Maybe those numbers come down to maybe even 0 to 1%. But I think these are fairly resilient companies, and one of my favorite points that I keep making is that Hindustan Unilever has given you 31 out of 32 quarters of positive operating profit growth and margin expansion. How many companies in India have done that? So if I'm getting a Hindustan Lever at 50% ROIC, 100% plus ROE, ROC, I'm happy paying 50 times, I'm happy paying 60 times, because I know at least I won't lose my capital there, as opposed to, say, investing in an oil marketing company or an auto component or
so
an auto
not necessarily you're paying for growth, because even
Absolutely.
for an HUL, you're not seeing the growth justify the valuations getting, but it's the visibility of the growth. That
Absolutely. Not only that, it's capital protection. Yeah. You're probably not looking at asset price appreciation in an environment like this. You're looking at capital protection, and the market is getting narrower and narrower. And I think I can't explain it to you any better than if you take the HDFC quartet in the last 1 year, just to give you how the market is shrinking. The money is actually moved away from HDFC Limited and HDFC Bank to HDFC Life Insurance and HDFC Asset Management. If you see the stock price performance of these 4 companies. So the point is that the market is actually getting narrower and narrower. Optically, you are at a 12,000 index. I could probably name you 10 stocks if you were to rationalize them. So going back to your point of stocks at 70, 80p, let's assume you get them down to a 40p by doing a discounted cash flow. I think those 10 stocks are probably trading at a 14,500 Nifty, according to me. And there is a large part of the market that's probably trading at about 8,500, 9,500 in that range. You're getting a weighted average because of the weightage that they command on the index, and you're getting a 12,000 Nifty. So I'm sorry for sounding a bit repetitive here, but I, as a fund manager, for the life of me, can't see myself selling a Nestle and buying a BHEL. I won't have the comfort to sell a Nestle and buy a State Bank of India. I won't even have the comfort to sell a Nestle and buy a Power Grid, which is a regulated ROE business. So to that extent, I think, you know, it looks obscene. I totally buy your point. We downgraded Nestle for the first time since we initiated coverage last quarter, because we couldn't, you know, we put a 72 target multiple, and I was like, this madness, at least internally, I was like, this madness has to stop somewhere. I mean, I'm happy that if it keeps going up, but you can't just keep putting obscene price targets. So I buy your point, but if 8,000 crores worth of SIP money keeps coming in,
it's a function of liquidity, and
exactly, and the fund managers are just
conversation.
comfortable with these 15 stocks. The rest is all academic discussion.
Yeah. Okay.
Unfortunately.
Let's see if market continues to give the scarcity premium that we've been so far, you know, giving it all these consumption.
As so many people have said this in the past, that it works until it stops working. Let's wait and watch.
And you know, it's interesting that, you know, to that point, you still didn't make that statement, but, you know, we had Howard Marks on Bloomberg, and he said that you classify a bubble as a bubble when you hear people saying that no price is too much for this particular stock. I don't know whether we've gotten to a point with certain stocks.
If you allow me just 30 seconds, I started looking at consumer in 2005 in another company with Neeraj, and I have seen people disbelieve when Hindustan Lever's valuations went from 30 to 35, 35 to 40. At every point you had disbelievers. I think I don't know when that tipping point will come, because I've been, you know, I won't say I've been waiting for it, because I'm a personal holder in these stocks, so I haven't been waiting for these stocks to fall, but I've been hearing this for a very long time. I don't know. I mean, you know, my mind goes back to, say, a consumer Whirlpool, for example, because it's hit a new 52-week high. It's been hitting new 52-week highs pretty much every day for the last few days. Even in the demonetization year, in the demonetization quarter, he grew 0.5%. He didn't degrow. there is a story to be told. I think, sometimes the price, the economy, everything is all over the place right now. I think you just need to appreciate the beauty of the fact that you're getting growth.
And the common
whatever
thing,
that growth may be.
Yeah, the common thing is most of the companies you've mentioned, Rahul, are all MNCs. They could be in the consumer space, but not all Indian consumer companies. Marico has not been able to give up that sort of performance. I'll have to cut you off. I need to take closing strategies. Sorry. Brijesh, a few minutes to go. Markets have given up all the gains, at least in Nifty. Any BTST, any STBT for Monday's session?
Stock specific, if you ask, then I have two stocks for a stock specific. One would be Maruti. Maruti has been coming down somewhere around 71.39, 71.40. The stock has been trading, so one can go short in it with the stop loss of 71.85. Look for the target of 7,040. Another counter where the selling pressure has been emerged is Reliance Industry. No doubt in today's session we have seen stock making a 52-week high of 1489, but presently the stock had given the lower highs on the oscillator front on the shorter term time frame, which indicates more pressure would be coming. So somewhere around 1465 the stock has been quoting, keeping a strict stop loss of 1478. Go for a sell side, look for the target of 1440 to 1442.
Pritesh, what about you?
I think one stock which I would like to create short from here is Asian Paints. We discussed about how the HUL was panning out against the FMCG and consumption basket. I think that is the short-term shorting opportunity taking place even in Asian Paints. On the PNF chart, I can see double bottom sell taking place, multi-column sell taking place. So I think Asian Paints could see levels of 16,090 maybe next couple of days, 1690 next couple of days.
So those are a couple of thoughts on some trading strategies as well. Rahul, before we thank you, we've spoken about astronomical valuations quite a bit. Are there trough valuations in pockets which could show growth wherein you might be bullish? We have about a minute and a half.
So I'll very quickly, Neeraj, I think pharma is probably the space to be. There's a lot that's going wrong for that sector right now, but I think there is so much option value to be got there if things start going right, that I wouldn't be surprised if 3 years from now, if everything goes right, Sun, Aurobindo, Reddy's are all probably available at double the prices that they are today. I think all of them are trading at between 13 to 15 times. It's not the worst place to go out and shop. I'd be concerned about IT. Don't look at the valuations because I think they're not probably going to get growth there. But I think the other space is probably product-oriented capital goods companies where you have visibility on order book and those companies will deliver of some amount of that order every year. The working capital is much better. The cash conversion cycles are much better. So I think pharma and probably capital goods product companies are two spaces where I think valuations are fairly reasonable. But just in conclusion, the point that you made, I think it's a very, very valid point that you brought out, that it never stops till it stops. Lever from 2000 to 2010 moved in a 100-point range. Yeah, so it can the giant can go to sleep. The point is it never lost people capital. On an absolute basis, on a relative basis it did, but you probably slept peacefully. It's like Bombay real estate prices. They probably won't rise, but they won't fall. So it is very possible that these stocks go to sleep for a period of time, but I find it very hard to figure out that lever will ever go back to a 35-40 PE multiple. I'd be shocked if I see that. Well, but then the markets are here to surprise us, as always, I think.
Yeah. Well, take a moment to thank you, Rahul, for joining in today and giving us your perspective. Appreciate your time. Just wondering, as the bank Nifties come off too, Pritesh, would you take a closing strategy on the Nifty Bank?
I think the bias is pretty clear. We had a pretty good performance from the index driven by Reliance and other stocks. But while Bank Nifty was consolidating, gradually moving higher. Now I think Bank Nifty has taken the leadership. We earlier in the show we spoke about how likes of HDFC Bank and Axis Bank could make a comeback. So I think Bank Nifty is definitely in buy mode. We can see it attempting 31,500, 600 maybe next couple of weeks.
Jaman, we'll take in closing thoughts from you, but very quickly, let's start wrapping up the markets. The Bank Nifty, we already mentioned 0.8% higher in trade, off the highs of the day, but nevertheless in the green. The mid cap and the small cap indices should come up on your screen as well. flattish performances. Let me quickly mark what's happened in the large caps, and then we'll mark the mid caps and the overall market picture for the week as well. The telcos, who would have thought about this yesterday, but they have done that. I think the amounts being declared is the big thing. And then State Bank of India, the third big mover in trade today, 5.5% higher on the resolution of the Essar steel verdict. Z, Grasim, Cipla are amongst the other names. Kotak Bank to about 1.5%. What's not doing well? IOC 4% lower, Hero Motor 2% lower, BPCL 2% lower, and some of the other names, auto names like Maruti and Eicher too, have looked wobbly in trade. Navneet, what about the broader end of the spectrum?
Well, Neeraj, it was a divided house. You had gainers as well as losers. So let me begin with something like Divi's Laboratories, which gained after the inspection got over by US FDA. No observations were issued for their Unit 1. You also had Glenmark, which posted good set of numbers operationally, and that probably that was the reason why you saw the stock moving higher, up almost 6% in trade. And we've been discussing Cholamandalam investment on the show, how the stock touched 52-week high. There are fresh long positions on the future side, and also on the cash side, you have been witnessing cash-based buying here. Balkrishna Industries moved higher on back of the numbers. Once again, this one too operationally posting good set of earnings for the September quarter. 859 is the level where it's closing. And the PSU banking stocks were in focus because of the Essar steel case. So you had Bank of India as well as Central Bank moving higher in today's trade. Both the banking stocks saw gains, sharp gains. In fact, Central Bank was up 18 to 19% too at one point of time. I think it came off. But moving on to losers, Indigo didn't have a good session this Friday. That was down nearly 3%, and profit booking seen for something like HDFC AMC, which has been moving higher at least for the week. So that one fell about 3.5%. DMart also came under some bit of selling pressure. No major selling, but still it was off about over 2%. Prime Focus was the other one, which fell in today's trade, and I guess this one fell as much as it was locked in lower circuit, down 20%. MGL, which has been witnessing a buying post its earnings, saw some bit of cool off. So this one also saw some bit of profit booking in today's trade.
All right, we've got a weekly close today. While the day has shut shop in the green, we've bounced back and the banks have supported smartly. The Nifty closes just around that 11,900 mark, not managing to surpass it. In fact, giving back some of the gains, because when we started off the show, we were somewhere closer to 11,955. From there, it's come off. The Nifty Bank at 31,000, still holding on to that. Quickly looking at the losers and gainers for the week and how the Nifty itself is done. So we're down marginally for the week gone by, but what's done well on the back of today's gains as well is Bharti Airtel and Bharti Infratel. Both these stocks are up and about. State Bank of India has been consistently doing well since the announcement of its results, and today providing that additional booster, got the stock up about 2% for the week. ICICI Bank, HDFC, so the banks have done really well. What's not done well is Vedanta. They've cut their guidance, so that's not worked in their favor. Hindalco, Adani Ports, UPL, Larsen & Toubro losing about 3%.
Okay, well, while you had Nifty, which had a session of consolidation, I'll call it this week, of 150 points. For the broader markets, Nifty mid-cap, marginal gains, 0.5%. You had stocks like AU Small Finance Bank, which rallied nearly 16%, and we've been discussing Edelweiss, how that stock has recovered from the lower levels. For the week, it was up 15%. Amara Raja reacted positively to the earnings. On operating front, I think margins were higher. Arnam went up 12%, Cholamandalam Investment, and also something like InfoEdge had a good week. On the losing side, Adani Power, Sterlite Tech, Nalco, the numbers were not that great, and also you had something like Jubilant Life Sciences, Tata Power, Future Consumer. All these stocks fell between that range of 8 to 9%. All
right, quickly just want to look at India VIX, because I think it's fallen off in today's session. So down by about 4.5%, closer to 14.97. It's not really near the lows yet.
No, not yet, but it's second straight day of sharp fall. Below the level of 15 could be a very comforting sign for the bulls at least.
All right, and lastly, just the turnover. Then we take a quick call from our technical experts on what is to be done next week. 39,000, just about at par for the F&O space, about 8,61,000. Let's get into those closing thoughts from Brijesh as well as Pritesh. Brijesh, I'll come to you first on next week's trade.
There is nothing wrong, and Nifty has gone in a correction mode, but still the momentum for the buy has still been strong. And till Nifty trades about 11,750 or say 11,770, buy on dip strategy can't be ruled out. Whereas on the higher side, it's been concerned for the next week, Nifty has a resistance at 12,070 to 12,080 band, but probability chances are that Nifty might try and make a new 50-week high. So if I talk about the broader range for the Nifty has been concerned, 11,770 or say 11,800 on downside, followed by 12,070 on the higher side. If we are able to surpass that thing, then the next level to watch would be 12,250. Whether the Bank Nifty has been concerned, it looked more promising as compared to the Nifty chart has been considered 31,000 somewhere around the Nifty. The Bank Nifty got close till Bank Nifty trades above 30,450 or 30,550. 30,450 to 30,500 band. That should be kept as a stop loss. Any dip should be used for accumulation purpose. Whereas on the higher side is been concerned, 31,650 to 31,700 is a mark which I would be watching very carefully for the next week or say coming days to be concerned.
Okay, Pritesh, what about you?
See, we had a good Diwali period. Nifty moved from 11,100 to 12,000. Thereafter, last 2 weeks, we have seen a classic sign of congestion taking place. Market has been struggling to move forward. It is even struggling to break down. So I think this phase of congestion is going to continue. And during this kind of during this kind of setups, we are supposed to focus on our performers. And we did talk about the strength in private bank index. That's what we should be able to identify in next couple of days. We should focus on these outperformers because market is going to spend its time in this congestion range.
Okay, we leave it at that, gentlemen. Pritesh as well as Brijesh, appreciate you both taking out this afternoon and sharing your thoughts with us on this platform. And with that, it's the end of this session of Countdown from Neeraj, Navneet, myself and the entire team that's put this show together. Thanks a lot for watching. Have a great weekend.